Hey everyone, I want to talk about a few things briefly about day trading and futures and what it all means essentially. So first things first, futures are different because they are a binary product, contracts on commodities, and you can choose to do them on the indexes like the S&P and the NASDAQ. Okay, there is no day trading rule across the board for futures. There's only a day trading rule on options. You get 3 day trades per a rolling 5-day period in an account lower than $25,000. The net liquidating value needs to be by the end of day above 25,000 for you to avoid being penalized for day trading in general. So that's a distinction between options trading and futures trading whenever it comes to what we call the pattern day trading rule, or whenever you hear the PDT. Okay? So margins are another thing. Whenever it comes to futures, you have a thing called margin. It's basically the required net liquidating value that needs to be placed in your account for you to take on one contract at a time. And what it all means is basically how much buying power are you taking up if you're buying or selling one micro future contract on the NASDAQ for this example. And you can see buying power here. The margin is about $2,000, a little bit more. And it's all different for each individual future contract. You can see I switched this to the micro S&P, and you can see the buying power, or the margin required for you to trade this specific instrument, is a little above $1,500. So you can start a small account and trade micro futures with about, anywhere from $2,000 to $2,500, and then intraday margin varies, which is basically a little extra money that the brokerage will allow you to play with, so as long as you keep a certain balance throughout the day. Each brokerage is different. You'll have to look into that for yourself. But at the end of the day, if you have a negative position and you're taking on negative and you're not able to cover the margin of the contract that you're sitting in, we have a thing called a margin call, where you must make up the difference if you are going to hold on to that contract, or they'll liquidate the contract for you because you no longer have the margin or the buying power to hold on to that contract. So therefore that contract becomes void because you do not have the net liquidating value to back up and to hold the margin. Okay, and this is a big thing to understand because you need to know how many contracts you can trade. You need to also know how a negative position may affect your overall position in the following days. So overnight, you don't get to use intraday margin, as so you would want to be able to know exactly what the deficit is going to be whenever you have multiple contracts on, especially if you're taking a lot of heat or in a losing position. So margin requirements, PDT rules, two different things, two different instruments. Whenever it comes to PDT, it only is for options. And with futures, you do not have a PDT. There is no limitation on how many times you can be in and out of a position. And I think those are the two most important parts of options and futures. Continuing on a little bit more with futures, let me tell you the pros and the cons of margin. The pro is you get to put more money at risk. You get to, get kind of a free gift of, you're able to use more contracts, be able to trade more, whereas to make more money. At the downside though, if you are over leveraged and you are taking on negative position, or you're in a losing position, you have to ultimately owe your brokerage the difference, or the amount required for you to either hold that position or to pay the brokerage what you owe from the margin that you borrowed that in this hypothetical case may have gone against you. So I have this platform up here just to kind of show you the different futures contracts. You can look at the 10-year, the 2-year, the 30-year, the 5-year notes. You can see the micro Russell. If they all start with M, it's a micro future. If it does not start with an M, it's just a regular contract. But I have this setting to show me all the micro futures across the market. Okay. So there's different types of margin. There's intraday, but then also for larger accounts, and I mean much larger accounts, you're able to use extended hours, and it just kind of all depends on your brokerage. Futures trading hours are generally just assumed to be 24 hours, but there's a few little break periods throughout the day. Futures pick up Sunday afternoon at 5 Central. They'll trade all the way into the overnight for Monday. They'll continue to trade all the way through Monday for the day. They'll trade all the way to 3:30. Okay. And then there's a break. And then from 4 to 5, there's no futures. It's basically, you know, there's an hour-long break, and that's basically through Monday through Friday, and then Friday futures closed in the afternoon and Saturday. So until the next Sunday afternoon at 5 o'clock Central. All right, and I say Central because I'm in Central Time Zone in Austin, Texas. The best platforms to trade with, I would say Tastyworks for a beginner, TradeStation for intermediate to veteran. And I like those two. I mean, I'm a veteran trader and I use Tastyworks just because I also, you know, trade in the Tastyworks platform. You know, as far as like trading hours for futures, I used to trade overnight micro futures. I don't so much anymore. I think the best practice is to wake up, look at the morning overnights, trade around 9 o'clock Central, let the market open up for about 30 minutes, allow it to kind of digest whatever it needs to do, and let your indicators soak up all the data to allow your indicators to work properly. And then, you know, from there, most traders trade between, you know, 9 o'clock all the way into 11:30 for the first 2 hours of the day, and they come back in the afternoon for the last 2 hours of the day. Okay, so be aware of the futures trading hours. Be aware of the break, basically from 4 o'clock to 5 o'clock, and then know where they start at 5 o'clock on Sunday afternoons. There's a huge advantage to trading micro futures over regular futures because they're so much smaller and they require less buying power or less margin. So that's something to look into if you're a new trader. Also, the PDT rule does not apply. Remember, it does not apply to futures trading, but in options trading, you also get, this is, I guess this is a good thing to know. You don't have to, you know, there's no harsh consequences after your first violation of the PDT rule. In other words, you did 4 day trades in a 5-day rolling period. You get one 90-day reset after you've broken the rule the first time. So if you break the rule, you can certainly day trade the next day as long as you reset your account through your brokerage. It's via an email or a button that you click on in your brokerage site. Or, you know, once you do that, you reset it and you get one reset every 90 days. So essentially you can actually day trade a little bit more than 3 times, just so as long as you don't do it every, you know, within a 90-day rolling period. You know, there's ways to get around it, but I think right now starting out, it's a good summary of how to look at things and be able to do extra day trades if you need to.
Thanks for watching this video. If you've enjoyed the video, be sure to like and comment down below to help us out. Also, be sure to subscribe and click the bell icon so you can get notified when we release our next video. And if you want to watch us trade in real time using our own money, go to simplertrading.com to learn how to sign up. Good trading, and we'll see you in the next video.